Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Welcome to another episode of the What Matters podcast. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And today we're honored to have Alan Harris as our guest. Alan is the founder of Berkshire Money Management, author of 2 books on finance and retirement, CEO of 10,001 Hours, and a passionate advocate for his community. Welcome to the podcast, Alan.
Thank you for having me.
Thanks for joining us. Alan, your journey and your contributions are truly impressive. Let's dive right into your remarkable story, all right?
Oh, you're sweet. Thank you.
So you founded Berkshire Money Management in 2021. Can you take us back to the beginning with your experiences in the financial industry? You were at Smith Barney, and what led you to start your own firm?
Yeah, I was too stupid to realize how hard it was going to be, really, I guess. Smith Barney has gone through a bunch of iterations since the great financial crisis, and they think they're at this point they're part of Dean Witter. They've kind of do buy out and phase out. And went from there to a boutique firm, RIA, that was doing similar to what I'm doing now. And at one point, I was the best salesman there. And when you're the best salesman, you get to put on your card whatever you want. And so I had chief investment officer, which was totally a lie for a 26-year-old, and a much smarter person running the firm. But the actual chief operating officer and I decided that we can do this on our own. And so we simply said to each other as two professionals who respected one another, let's join on, let's break off, do this on our own, and try to build something for ourselves. And the idea was he was going to come in for a few years and I'd buy him out. And that's what happened there.
Oh, really cool.
Yeah.
So let me ask you this. You met the COO, you met the COO, you were the quote unquote CIO. You guys said we can do this on our own. You guys left. Is that individual no longer your partner at Berkshire?
So we at the same time started a newsletter business and an RIA, and he came into it saying he wanted to build it up, kind of get things running at the operational side. And so I was able to run that with him. And then maybe 3 years into it, I bought him out, and that was a good investment on my side, but he had a good price on his way out, so we're both happy with that consideration. And so he left, and we had the opportunity to continue running the newsletter because that was part of how we started our business. And I find in marketing, it's not necessarily the right thing, but it's the right thing at the right time with the right message and the right media. Everything has to line up pretty well. And it was pre-iPhone. It was free information in your hand everywhere. So we were able to go out and rent lists from other newsletters, other financial newsletters, and other financial publications. So we knew the what, and the what was people who would pay for a subscription for financial information. And we spent a long time handwriting envelopes and live stamping them. So we increased the open rate, and we increased that to about 16,000 subscribers. And at some point we said, it's a lot. It's a whole different job other than just investing money. But more importantly, our job as investors is to kind of look where trends are going. And the trend was more and more of this information that I'm charging people for is becoming accessible and free. Let's see if we can't sell this. And so we sold it. And for that, we probably sold it around 2006. And actually for a very short time, we probably had a couple $100 million of assets under management at a time, and there was just maybe 4 employees. And the idea was maybe it would just be a lifestyle practice, whatever it was, maybe 150, 200 clients. It's not a bad living with a couple $100 million of assets under management and not a whole lot of overhead. But then things changed.
Right. So your work extends beyond traditional financial advisory services, obviously. With the creation of 10,001 Hours, could you please tell us more about your satellite company's focus? You highlighted on that a little bit. Was there other motivations for that besides it being something that you use as a marketing tool, or
There's
was it?
certainly some of that. So 10,001 hours, it's a little play on the 10,000 hours that Malcolm Gladwell writes about. You need 10,000 hours of practice of a particular skill to become an exit. Our company would be the extra hour on top of that you practice your skill. And what happens for a lot of people who are really great at what they do is that before they know it, they become a business owner, and they've got to hire
Right.
people and develop processes and have different workflows and all these other considerations they didn't think of when they're just doing that one thing that they're really good about and passionate about. So the idea was we'd come in and help business owners grow that. And that came from a place of my self-awareness that I don't know what I'm doing. If I went from financial advisor, and I felt I was good at it, we all do, otherwise we wouldn't be doing it, I suppose, into an accidental CEO. Now, for a 20-person firm, CEO almost sounds like an odd thing to call yourself, but it is definitionally correct. Where I set strategy, and before that, it was CEO and COO with the operational side. And I wanted to be better. I wanted to make sure that I knew what I was doing, because you look at restaurants, and I've got some friends who are restaurateurs, and it's a tough business. And
Oh
a
man.
lot of chefs get into the restaurant business, and then we've all seen the stats. The restaurants fail, and it's not
Yep.
because they're bad chefs. It's because the margins are so thin, you don't have a lot of errors. You can't make a lot of errors. In the financial advisory business, we like to think that we're pretty smart, but hey, if you start a business when you're 20 years old, you probably ain't that smart. I know I wasn't. But I did realize that we have pretty wide profit margins. So I was able to make some mistakes along the way and not go out of business. But I didn't want to live on that edge of I can make this mistake, I can make this mistake. I wanted to get better at being a business owner. And so I gained, yes, experience, but also pursued continuing education and collected designations and certifications so I can be better at what it was. And sort of organically, we developed two different niches. Had nothing to do with one another. One is healthcare professionals with a heavy emphasis on the nurses, or at least a preponderance of the employees are nurses, and then business owners. And one is just because of our community footprint and the work that we've done with them, and the other is just because, quite frankly, a lot of times business owners are great delegators, and they have fairly sophisticated needs, so they need firms like Berkshire Money Management. And so I was able to have conversations with the business owners saying, oh, you have that problem too? We're not in the same industry whatsoever, but we're banging our heads up against the same conflict, the same area, the same workflow needs, the same compliance issues, whatever it happens to be, and kind of talk through, and with a lot of passion. Like you might even hear it in my voice, but I can feel the elevation in my pitch just talking about owning a business and trying to work through problems. And so we want to develop a more formal process for our clients as an additional service. And what we found is that our clients who received those services and had that conversation had other business owner friends and colleagues who also are passionate and also wanted to have these types of conversations. So you mentioned marketing. It became a lead magnet just because I enjoyed those conversations.
Really cool. Hey, I like what you said there, because you said you were a sales machine, right? And that's, I can relate to that because that's always been my strong suit. And I have a twin brother who's my business partner, and we always had this philosophy of let genius do their work best, right? And in our last business, I remember my business partners had wanted me to meet them in Austin, and when I got to Austin, they I had just gotten done, as I said, we were in the mortgage business, and I think rates were really low. This is 2016, and it was right before Trump had gotten elected. And I think for that year, I had hired about 450 loan officers already, right? But the one thing I didn't take in consideration was because everybody was so new to the organization. Well, Ashley being one of them, because we've worked together for 7 years now. That those 400 individuals that I hired were going to have personality issues and, lead management issues and what have you. And before I knew it, I wasn't hiring anybody else. And with the rates that low, the attrition was pretty heavy as well. And they flew me into Austin, and they said, hey, listen, we haven't hired anybody in 2 months. Like, what's going on? And I started telling about all these different problems. And they said to me, no, that doesn't matter. Back away. Just keep doing what you're doing. And it was just a reminder that that was probably the third conversation that I've had with my twin brother in regards to what I need to do and, what area I need to be in. For, fast forward, as we're on this podcast right now, all my business partners are meeting in Southern California, and I said I'm not going to go. And I said the reason why I'm not going to go is because I can't take myself away from the several podcasts we have and sales calls that we have to pick out what the company logo is going to look like, or talk about what tech platform and CRM we're going to use. I trust that I've partnered with great people, and you guys are going to make those decisions for me. So I appreciate what you're saying there.
And it's interesting what you mentioned in terms of taking yourselves out of those meetings. It's kind of an interesting thing. One way that we've been able to develop as a company is making sure our capacity for every individual is focused, number one, at their highest and best use, but also they're not tied up doing other things. And there's a sort of in the corporate world, if there's a meeting, once upon a time, if there's a meeting and you weren't in the meeting, it'd be like you weren't important enough to be in that meeting. But now we're deciding and have determined, at least in our culture, it's almost a badge of honor not to be in the meeting. Like what you're working on is so important that we don't need you in on the logo or whatever happened to be using your example, because we've got other smart people doing it. While your input would be valuable, it's more valuable doing these other things.
Right.
And so you're doing what's best really for the firm.
Yes. Yeah. And again, doing what I like to do, so such as what you were talking about, not doing the things that you're forced to do. So
yeah. Well, that's part of what I like to do here. I have those conversations a lot. There's different projects that we might want to work on, and some of them I've felt strongly about but abandoned because they didn't have the same buy-in and passion. And some of that could have been me not articulating correctly so people can see what my vision is, but some other people just simply don't disagree. And while I might be the owner, or one of the owners, we do have some form of democracy in the sense that if you can't see the path to what I want to accomplish, you're not going to have the same type of excitement and passion about it. And if you don't have ownership of a project, it's just not going to be completed the same way. Yes, you'll perform the tasks, and maybe even you'll do a great job, but at what cost? Part of that could be morale deterioration. It could be a distraction from the things that are, again, your highest and best use. And you can have dual highest and best use, or even triple. So that's part of like what we would like to do, is to be sure that if someone's going to take on a task, that is something that they're really passionate about. Now, that's not always the case. I mean, sometimes you're going to find me out on the lawn picking up trash. I don't like to do that, but someone's got to do some of the work sometimes that you don't want to do.
Right. And let me ask you this. So the 10,001 hours, is that primarily you running that, or is there others within, the Berkshire organization that are helping with that project?
So a little bit of shared work with BMM employees, and also some outsourced help. So within the group, Lauren Russo, actually I have two cousins that work with me. Lauren's one of them. And she has not only her CFP designation, but certified exit planning advisor designation and certified value builder designation. So she also knows a thing or two about how to work with businesses. So we can partner on those conversations. But when things get hard and heavy, I mean, there's levels to every game. And while I like that and I enjoy it and I know that thing or two, if things are really super complicated, I can reach out to a bunch of different people who actually teach these things on a national level and have done so in the past and brought them in. But also have, I would not consider myself a broker in the sense of mergers and acquisitions. So if someone wants to sell the practice and run through, here's a document assigning all the usual reps and warranties and all the things you need to have to make sure a deal is closed and due diligence is done. I'll find someone who I work with someone who has done that for him and his father for 30, 40 years.
Okay.
You want to make sure that the right people are doing the right job. And sometimes my job is really just to understand the need and then to facilitate the connection.
Absolutely. So in addition to BMM, the satellite firm, you've also, you're the author of 2 books, Build It, Sell It, Profit, and Don't Run Out of Money in Retirement. Can you tell us a little bit more about those books?
Yeah. So Build It, Sell It, Profit is more about the 10,001 hours company. And that was my homework assignment to myself, really, to say at some point, Alan, you're going to want to sell this company. And that's your retirement plan. You're going to find a monetization event in 15 years hence. And in order to do that, you want to run a company that isn't going to run for 15 years, but is going to run for 40 years. You want to build a business that doesn't need you, as hurtful as it can sound sometimes. It doesn't need me, but also that can continue for years and decades afterwards. A transferable business, not just a valuable business for the moment, but a transferable business. And so that was my own homework assignment to myself. That I was then, of course, able to share it to my other business owner clients and colleagues. And don't run out of money in retirement. We have conversations, all of us here, especially on the business development side and on the service side, and it's what is the biggest need of our clients, and not even necessarily need, but what is the biggest fear of our clients? Because sometimes their biggest need isn't one they've even considered. I mean, we find sometimes the highest value you can give to a client is identifying a question or an answer they didn't even have the question for. But their biggest fear oftentimes tends to be running out of money in retirement. And so you get a lot of people, this business, you get a lot of people who select a financial advisor when there's money in motion, whether there's a loss of a job or an inheritance or a marriage or whatever happens to be, there's money moving or divorce moving one way or another. And the most common one tends to be retirement. And a lot of times they need to come to you almost with permission. Can I do this and still be able to, I'm used to a form of income, a W-2 paycheck or owner's distributions. How am I going to replace that income now and have the standard of living I'm used to without running out of money in retirement? And so that was a book that answered that most important question to at least our clients, and then some tactics, I guess you can call, or tools in the book designed to show how you could get through retirement without running out of money.
Can you share a few of those?
Yeah, that's what I was just going to ask.
We won't give it all away, but any key tactics?
Well, the biggest part that we're finding, and it's before I get into that, I'll explain quickly sort of the evolution of our industry, or at least the companies who are trying to pay attention. And you go back to like the 90s, it was all investments. It's the only thing you did. And unfortunately nowadays, the financial industry does not do a good job telling prospective clients what they do. So I promise, Ashley, I'm going to get back to those tactics there, but I want to give a proper context to it. And I remember a little bit before COVID, I had an opportunity. A mutual friend sat me down with a head of a private equity firm, and they do what they do. They buy companies, no specific industry, that are somehow struggling. They put some capital into them. They turn them around, make them more efficient, bring them up to speed and the industry's best practices, and then resell them. I was having a conversation with this guy. It was a great, fun conversation, and he was telling me, and he was going off just as passionate as I am out talking about things. And at one point, he says, "Oh, I apologize. I should stop. I'm doing all the talking, but I had a broker 20 years ago, and I know what you guys do." I'm like, "Oh, tell me what we do." It's like, you buy stocks, you buy bonds, and that was it. I'm like, and I was kind of, I want to say almost astounded, I guess, really, because I realized at that point, I had always had an inkling, but it really drove home the point that people don't know what we do anymore, or because if they had the idea of what financial advisors did, the industry has changed so much over the decades that it doesn't look like it used to. But the industry, has done a really bad job telling everyone what we do. And so I was also hoping to use that book for prospective clients who came in to say, there's a lot of stuff we can talk about, but here's by index, you can go in there and kind of take a peek at some of the things you want to look at. And the way the industry is changing in some ways is tax planning. Now, not necessarily tax compliance. I mean, you might find some RIAs. We are a registered investment advisor, followed by the SEC, regulated by the SEC. And you might find some RIAs who have CPAs and file taxes. But tax compliance is different than tax planning. tax compliance is making sure that you pay the taxes that you owed and you follow a deadline and then you're done. Tax planning is making sure that what you do now mitigates the taxes you have to pay over the course of a lifetime.
Right.
So, I'll give a good example of someone we're working on just recently. Someone who came to us, for us, a big client, and our average client's about $1 million, and this person who came to us with $12 million and a good broker who had good returns, but wasn't offering the other things in terms of financial planning and all that stuff. And he's like, I have these investments, but they did what they're supposed to. I'm over concentrated. I'm afraid that I'm going to lose some of this money as things are going to go down. What am I going to do? And so we're working with him now to create a donor advised fund. We're going to take some of the money, whether we haven't decided exactly what it is yet, but say it's $1 million, say it's $2 million. We're going to be able to put that in a fund that he's going to have control over, but he's going to get an immediate tax deduction by putting it into the account. One of the big things he's worried about is losing his money. But another thing he's concerned about is reducing taxes as much as possible, because as you can imagine, with a $12 million account, he's making some income. So we're going to work with him on that. He does have a business. We'll work with him on different ways that he can retitle his business, because right now his business is a C corporation, and we think there's a good way for us to go ahead and retitle it to an S corporation, because there's no need for him to be a C corporation. So there's some tricks that we can do for this gentleman, and for the average person, the average millionaire, maybe we're not going to apply those same tactics, but a lot of times we will. A lot of times it's more just the recognition that your assets are not being managed as efficiently as possible from a tax standpoint. So we've got a lot of people who come from one advisor to us to another advisor. And I'm not advisor bashing at all. I'm just telling an example of what's happened. And every single account looks the same. And so, which I can almost understand, because sometimes we have an account and one of the accounts is like doing really well compared to another account. Like, how come my account's not doing this great? Well, because we have all the interest bearing and dividend paying stocks and bonds in the tax deferred account. So your performance is going to be different than the other accounts that are meant to be an S&P 500 fund, for example, that we're never going to sell anyways. And so sometimes it's just a matter of those types of tax efficiencies and placing the right vehicle in the right account.
Yeah, I had another question there. I've had probably 3 or 4 different colleagues, respectable acquaintances, friends, that sold their companies in their early to mid 50s, and they had 8-figure exits, and they built their dream home or bought their dream home, and next they retired thinking, okay, well, I'm going to die at 70 or 72, and at 72, they've hit me up and they said, I got to get back to work. What, really? Because they ran out of their money, because they thought they got accustomed to a lifestyle, thinking, okay, well, my parents died in their mid to late 60s. I'm going to be good to like my early 70s. And now they're, late 70s, healthy. They're healthy as an ox. And they're like, they've outlived their savings. Right. Is that what you think is that what your experience that you've seen a lot of, do you see that there's a certain age group, not being an ageist here, but do you see that there's a certain age group where people make mistakes with their portfolio or the money that they've saved?
The quick answer is yes, but there's another mistake that people make in retirement that actually we see more frequently. And it comes usually from business owners. Employees, W-2 employees are a little bit different, but even the mindset of business owners can be different. You've spent your time building something, and now your identity is wrapped up in the ownership of this firm, and you're used to the social aspect of walking in, and everyone knows who you are, and they take your orders, and you're working in the next project. and you tend to be someone who actually enjoys what you're doing. And so a certain age group has lived their life knowing that I get out of high school, I go to college or go to the military, I get married, I buy a house, I have children. This whole I work for 40 years and then I retire. So it's this real sequence of life that we're used to, and we do it just because you're supposed to do it. So what I've actually seen more often than the financial mistakes is the lack of preparation for your second stage and not knowing what you do. So people will retire and like, I can only play so much golf. I can only go to so many islands. I can only, go to so many wine tasting events. I am bored out of my mind now. What do I do? And then they're ready to go start another business. And so then the conversation becomes, all right, what's the best way to capitalize this business with the money? You had a liquidation event. How are we going to pull this money back into something else? And usually it's never as big, because usually it's, that second stage event is something much smaller, but still you need to fund it. So we need to figure out the most tax efficient way and the cheapest way for them to go ahead and fill that time up.
Gotcha. And so if you could tell me a little bit about Berkshire. Well, first I had I hope this question doesn't come off as, I'm not going to misuse the word ignorant, but where did the name Berkshire come from? Was it a spinoff of?
Because we're so completely uncreative. So we live in Berkshire County. We manage money. If we made maps, it'd be Berkshire map makers. When we started, we didn't have a marketing team. Now we're smarter and better and on that kind of stuff. But back then, it was just me coming up with names. So we got stuck with where you are and what you do.
And so let me ask you this. Growing your RIA to almost $1 billion now, did you guys fuel that by inorganic or organic growth?
All organic, no acquisitions. I'm certainly not opposed to it, but what the stats I've seen is something like there's 50 buyers for every seller, and so every now and then you throw an inquiry out there on one of the broker matching sites and see if there's any nibbles. But I'm not too interested in chasing that, because what I found is, okay, so you can buy assets at. I hate the fact that our industry likes to use price to sales, price to revenue as a metric, because we should know better than that and actually be valuing things correctly. But for the sake of ease in this conversation, let's talk about revenue multiples. So you can go and buy a competitor and fold it into you for 3 times revenue. Okay, so you can also do one of 2 other things. You can grow via referral, or you can grow through marketing. And generally, businesses, RIAs, they grow primarily through referrals. But you can't grow by referral unless you have a client base from which to grow. And so we do both. We do a lot of actually continuing education in terms of how to best serve the client and have those conversations about referrals. But we also do a lot of marketing, a lot relative to the industry. And there's some studies that are out there where roughly 2% of the average IRA, 2% of the revenue of the average IRA is spent on marketing. And the average IRA is about a third of our size. And so we spend, and we're actually dialing it down because we're getting better at determining where the return on investment is coming from, but we spend about 10 to 12% on marketing. So the cost is pretty high relative to our competition for acquisition of new customers, non-first connection customers, non-referral customers. Say it's 1.5 to 2 times revenue. Well, that's still cheaper than 3 times revenue buying it. And it's a lot easier to onboard 40 to 45 new clients per year, which is about a run rate, than it is to buy 90 to 100 and then fit them in and then automatically have to shove them into the capacity of the advisors that we have. It's just a lot easier to stitch people in over time and onboard them into our system.
Right. And how many total advisors do you guys have now?
There are 8. Yeah,
cool.
I removed myself from being a client-facing advisor. Actually, I tried to remove myself from being a client-facing advisor when I sold the newsletter back in 2006, and then the Great Recession came. And I'm like, well, I better start talking to some advisors, some clients about what's going on. So I got pulled back in for a little while.
Real cool.
So do you still take care of your own clients, or do you pass them on?
No, I feel like proud papa. The advisors I have are way smarter than I ever was, and at this point ever will be. And they know financial planning and the financial planning software and the ins and outs of trust and best ways to save on taxes than I did. So the clients are in better hands with them, and I've moved over to sort of it used to be operational and CEO, but now really just the CEO side and investments.
Gotcha. So, Berkshire Money Management has seen great growth within, how many years you've been open?
22,
What was that?
22 years.
Oh, wow.
Yes.
Yeah.
So, what game-changing strategies or principles do you think, really propelled your firm to where it is now? What can listeners take away from your blueprint of success?
Well, I can only speak to our firm, and I don't know if you can take what we've done in our firm and bring it somewhere else, but hopefully someone can find some nuggets of wisdom in it. I think that the most important things, a couple of the most important things, has been that I try not to. We work on lots of projects, and I remember one point, perhaps we were changing CRM. I forget even what it was, but I remember it being another change, and I wanted to take some time to tell our employees, like, listen, we're going to do this, but it's going to seem disruptive, but you've done it before. So I took out a pen and paper and I went through a list of all the things we did, and I got to like 3 pages of all these changes that we made before, some big, some small. And the point was, we as a team and humans in general are really adaptive. When things change, we might be annoyed by it initially because it's disruptive, but it's not necessarily something that we can't do. And oh, by the way, once it's done, you kind of forget that it happened. It's kind of like our clients who are freaking out when they have that 7% correction, but then 3 months later completely forgot about it. And so we kind of forget the pain of things that happened. And so I feel that's important for firms of any industry to think about changing, not just for the sake of change, but because best practices that were best practices are no longer best practices. So there was a speaker I saw once, Lisa Bodell, and she had a saying, kill a stupid rule. And we kind of live by that, which is, especially when we have someone new come in, I feel pretty good about our onboarding system. We spend a lot of time with new employees when they come in to teach them what they're doing and making sure they feel supported. And so they understand the roles and responsibilities, but we also want to expose them to other things that are happening and give them the power to speak up and say, or at least question, why are you doing this? Because more often than not, the answer might be like, well, we've always done it this way, so we keep doing it that way. And so I've noticed that we've made a lot of changes when we've had new employees come in and say, I wouldn't do it this way. But they wouldn't say that unless you were able to make them feel valued and let them know they have the power to speak out, to let you know if you're doing things wrong. I don't want to be, well, I want to be right all the time, but I don't want people to be a yes man or woman to me. I need them to call me out when we're doing things wrong. And I think that's part of the secret of success, is to value the input to all your team members and give them the power to speak up and say, listen, you're not in the trenches anymore, Harris. You were never, a customer service representative. You were never answering the phones. You don't know that anyways. And by the way, you haven't been an advisor for X number of years. You have to listen to what we're doing. And I think that's pretty important.
I like that.
I think to what you're saying there, when your clients start calling you up on a 7% correction, it kind of goes back to 2020 and 2021, where you probably had 20+% gains or more per year. I'm just picking a wild number out of the air there. And, going into 2023, if let's say your average client invested $1 million and all of a sudden it was up to $1.4 million to $1.6 million, somewhere in that neighborhood. And then it went back down to $1.25 million. They never went and said, man, those are some great returns that you got me. They won't say that. Oh, Kathy Woods, she got 400% returns this year, and you only got me 25% returns. But then obviously they'll get they'll whiplash you there, and then like the next year, obviously, was 2022, I believe, and there was a correction. Did you see that? Kind of those 2 years that you had great gains, or steady great gains, and then you had a down year, and they're calling you up left and right saying, what are you doing with my portfolio? Were your clients like, I was going to ask, were your clients like me? Did they do that? Did they put you through that abuse, or were they more stabilized?
Well, the good news and the bad news there. The bad news is there were a few. The good news is it's a much smaller number than it used to be. Or like we were talking about the development, the evolution of the industry. And as you get into more, whether it's tax planning, estate planning, helping people with Social Security, Medicare, we do a lot of family meetings in helping heirs be prepared to receive their inheritance. We give them access to our financial planning software. So sometimes if the market's down, we can track and see like who's signing into the software and go into the quote unquote play zone and figure like, okay, if the market goes down 20%, am I going to be okay? And so we've given the people the education and the tools to realize that this is going to happen. You're going to be okay. And oftentimes when they call us, they used to call and be freaked out. And now they're calling and freaked out. And I just need to hear your voice and tell me it's going to be okay. And you do. And so the good news is you still get those calls, but they're fewer. And it's more like, just tell me it's going to be okay, and then I can go away.
Real cool.
Yeah.
And, as a leader in the industry, can you share, some unique leadership philosophy and, the lessons you learned about inspiring your teams, fostering a winning culture, and driving innovation in the RIA space?
Well, I'll talk about the team first. It's one thing to do. I did do that. It's just kind of a fun story. I think that I think is helpful, and this is a tactic I think that other RIA owners can do. It's hard to get people to take risks and feel empowered. So one thing I did, and this was maybe 3 years ago, I forget. I gave everybody in the beginning of the year an envelope with $1,000 on it. I said, put this in your desk. It's not yours. It's not yours until you take a risk and make a mistake. If at the end of the year you haven't taken a risk and made a mistake, I'm going to give it to charity. If you take a risk and you succeed, well, it's going to show up. It's going to be reflected in your bonus and your promotions and all that stuff. So don't try to make a mistake. But the point was two things. One is I trust you. You're smart. There's a reason I hired you. I want to not only empower you, but make you feel trusted in whatever you think is going to be great for the firm and for the clients. Do it. And the other part is, as a business owner, one thing you want to do is kind of take yourself out from what we call the hub and spoke situation. You don't want to be the hub where everything has to come through you at every single time. And so I used to get that, and business owners in general used to get that, and some still do, which is nothing takes place unless it goes through you. And not necessarily because you want to, because someone's afraid they're going to make a mistake. And that way, if they tell the owner first, it's like, I told you. And so they're off the hook. And this is my way of saying, listen, I don't need to be involved with it. Free up my capacity. Let's free up and streamline the chain. And it's okay if things happen. At the end of the year, there's one person who didn't do anything. And so that money went to charity. But I think that really opened up, and I haven't done it again since, but I try to tell all new employees that, because they understand right away, even in the interview process, I like to tell them that, because they understand what they're getting into. So it's a great way, actually, quite frankly, to close the deal if you're trying to hire someone. But also, you want someone on board who's going to be comfortable doing that. So that's, as far as a leadership tip goes, that's it. On the innovation side, sometimes it just pays to answer those emails or take those phone calls that you just know are going to be a waste of time from a vendor, whether it's an investment product or a software tool, and you get them all day long. But sometimes, it's that moment to grab it and listen to it and see what they have to say. Like, you know what, this actually worked out okay. This is an investment product that I can use, or this is a software solution that I can use. It's good to be open-minded about, going back to kill a stupid rule. It's good to be open-minded about hearing other people's perspectives on from vendors on if they can be a better provider for you.
That's great. Yeah, so
I
that
like
kind of
that.
segs into what I was going to talk about next. So, you're involved in several community initiatives. You received the 2021 BCAC Community Hero Award. Congratulations. Um, can you tell us a little bit more about your commitment to the community development and how that aligns with your values and your professional career as well? I assume that this recognition has impacted your dedication to the community engagement even more.
Yeah, generally speaking, I think people who get good at things like those things more. And if there's recognition of something, it kind of makes you feel like, oh, maybe I'm doing something right. And in the case of philanthropy, if you get recognized for, at least this is speaking, I guess, for myself, it's like, oh, I must be actually making an impact. And if I'm actually making impact, that means I should keep doing what I'm doing and find where else I can try to make an impact. So yeah, without a doubt, and you see other elements of that too. I mean, depending on what you're doing, you can either see a smiling face or a wagging tail or whatever it happens to be that you're working with, and you're making an impact. But when there's actual public recognition, it's almost that individual recognition, but on scale. So you do feel like you're making a difference. And the beauty, again, going back to the profit margins of, like we started this conversation, one of the beauties of the financial services industry is there's profit margin. And so you can take some of that profit and put it back into the community. And yeah, you can talk about how, if you build up the community, it's going to go back to you because, number one, it's going to build up the area, of course, because perhaps people want to invest with an organization that is similarly aligned to you, yes, but also it just kind of feels good.
Real cool.
To make a difference.
Wonderful. Absolutely.
Thank you. That's sweet.
So I wanted to talk to you about what your opinion of the future of wealth management is looking like. With your expertise, what trends, technologies, strategies do you foresee shaping the future of wealth management? How is Berkshire preparing for these changes?
Well, like I said, sometimes I take those calls or emails from different vendors, and then sometimes, quite frankly, I seek them out. And so what I've been seeking out lately is not all things artificial intelligence, because there's too many, but there are at least a lot that profess to have some form of AI. And AI has ranges in terms of its definition and ranges in terms of like how much scope there is in each product. But my sense is that that's going to be a pretty important space to be in, not necessarily in the investing side. Perhaps yes, but that's not what I'm referring to. There's Moore's law, and Moore's law says the computing power every roughly 1 or 2 years sort of doubles. And if you look back over the last century, computing power has doubled from whether it's steam shovels to vacuum cleaners to TVs to automobiles. I mean, we're getting into we're getting to a point where that doubling effect of Moore's law is pretty darn high. And if you use a lot of artificial, ChatGPT is the favorite reference of artificial intelligence tools, and I've got a subscription to it, and I enjoy it. I'm not trying to bash ChatGPT, but just being objective. It's an awful tool for investors and advisors. Well, for advisors, I haven't used it in investor standpoint, but advisor standpoint, because it stops its information, its archival information from back in like 2021, I think it is, September 2021. So anything that changes as far as deadlines and rules, it doesn't capture that anymore. But quite frankly, the hallucinations are scary. Are you familiar with the term hallucinations? Well, I'll mention it just in case your listeners don't watch it. Artificial intelligence, and ChatGPT has been guilty of this probably more than Bard and other ones. Its intent is to please the user, and it pleases the user by finding answers. And so it'll make up answers sometimes that aren't even completely true. My favorite case is, the pun intended, is a lawyer who used it for an opening statement and cited a case study as to why, this motion should pass or whatever. And the judge looked up the cases that were referenced, like, these don't even exist. The AI completely made it up. So that aside, so some parts of AI are not ready for financial advisors. It's just not a trustworthy tool or a time-sensitive tool. That being said, if you have your phone and you're texting somebody and you see, for example, a prompt, you can it'll be text predictive, like what word you might want to use. That's artificial intelligence.
Yeah.
If you're scanning an Adobe document for Control F to find the word, Ashley, it'll go to it. It's artificial intelligence.
Mm-hmm.
There's artificial intelligence tools that are out there that are going to make the practice more scalable. And so I been looking at more on the operational side. My marketing team has been looking at more on the marketing side, and it's pretty interesting. So what we've come to a conclusion to is it's probably not going to help us much on the revenue side, because the marketing still has to go through certain funnels. It's not going to close clients. But it's probably going to help a lot, not just for our business, but business in general, on the margin side and the capacity side. So what we're going to find for firms like ours, if you use the correct technology and you're open to using AI, is you're going to be able to have, instead of 150 people per advisor, I mean, obviously they're always going to shift depending on the sophistication of the clients and, of course, the advisor themselves. You'll go from being able to handle 150 relationships to 250 relationships. You'll be able to post more to social media to let people know of the philanthropic efforts that you're involved in, and someone sees that and they're aligned with that and they're going to come to you. And so that is, I think, they're going to be part of the evolution of business in general. But I've really been mostly just trying to pay attention to the financial industry, and I think that's going to make waves for us.
Real cool.
Absolutely. And going into other exciting investment, are there any investments right now or sectors that currently excite you, or emerging opportunities that you see for the next big wave of wealth creation?
Well, actually, my idea of excitement might be different than your idea of excitement. I fairly conservative. So I like to think when we're invested in the market, let's hopefully get what the market does in the upside roughly. If the market goes up 10%, I'm cool if we go up 8% or 12%. Just, I want to be directionally in close, directionally correct and close. My bigger concern is if things go haywire, that we want to be preventative in terms of capital loss. So, back in 2002, it was, I just used cash. Then things started getting interesting in 2007, 2008, and I could use things like absolute FDIC insured absolute return CDs, which were basically zero coupon bonds with options stuffed into them, but so they expired at par, but you had an opportunity to make money or lose money depending on which way the market went. In 2019, quite frankly, I felt strongly there was going to be a recession in 2020. Nothing to do with the pandemic. I did not see that coming by a long shot. That was not on my bingo card. But in preparation for what we thought was going to be an economic downturn and, of course, cause a stock market tumble, we started using a more defined outcome ETFs, which is basically flex options. You can buffer your loss. You capture your return, but it buffers your loss. And I'm still using some of those. And they were very attractive to me back then in 2019 because bonds weren't as attractive to me. There was no yield that was, great. If I think a recession is coming and I put you in a bond, there's not a lot of juice in that particular play. So that was my idea. If you go to your local hardware store, you're not trying to buy a 1-inch hole. You're trying to buy you're not trying to buy a 1-inch drill. You're trying to buy a 1-inch hole. Right. And so I didn't need to buy a bond to be conservative. What clients I want to do to protect them is find an instrument that offered some type of return but not a lot of volatility. My amateurish forecast, I say amateurish forecast because economic forecasters are always so bad at it, so I'm not going to try and I have some additional level of prominence that nobody else has, but I feel like there's probably going to be a recession sometime in 2025, 2024, who knows, but it's going to come. And for me, my exciting investment is oh my goodness, bonds are back. And I remember being in a conference, whatever it was, a couple of years ago, year and a half ago, about how the 60-40 model is dead. Well, it turns out it died because bonds died, but they've been brought back to life. And so my exciting plays when we do feel that the market's going to take a tumble is to get back into bonds again at a time when hopefully inflation is inflation is back down, and the Fed will feel comfortable reducing rates because recession is going to occur. So you'll get not only the yield, but a little appreciation on as well. So my excitement is being boring again.
His bonds.
Yeah. So
Well, fair enough.
To wrap up with my final question there, and you kind of highlighted on that already. Obviously, we've seen some unprecedented events that we haven't seen before, such as the debt load, interest rates going up as rapidly as they have, with a recession on potentially on the horizon, right? Usually when a recession hits, interest rates tend to drop, which means people will pull their money and shove them into equities or whatnot. Do you see that occurring, or do you see more of a stagflation? What do you think is going to occur there? Because obviously, I could tell you from my experience, I've probably diversified 50% out of the equity market and into the bond market in the last 30 days. Because I and I could be wrong. I know that I try to be a contrarian in the marketplace, but when I see things that are pretty obvious, it's just the S&P has been roaring this year. I don't think anybody saw that happening. If in the beginning of the year, I remember going on YouTube videos, and they're like, the S&P is going to be at 280 at the end of this year. The look of it right now, it looks like it could break 2021 highs. What's your prediction there?
So speaking of being contrarian, just to give some context as to like who's saying what here. About a year ago, I think it was June of last year, I was at a conference, and it was amazing how dour the attitude was. I had the audacity to say, I think a year from now the market could be up 10%. And they're like, it was so bad that the moderator, a former CNN financial editor, was jokingly ridiculing me enough because it was kind of fun. Like, this crazy guy thinks the market's going to be up a year later. And depending on whether you looked at the S&P or the NASDAQ, S&P is up 5 and the NASDAQ is up 13 or whatever it was. So I was like pretty close to it. So fortunately, I had the opportunity to go back to the conference a year later and just let people know it wasn't crazy. I didn't like wave that flag necessarily, but so I too tend to be a bit contrarian. And so we've gone from the conversation about from hard landing to soft landing to no landing. I think it's naive to think that there will be no landing.
Yep.
For a couple of reasons. Number one, recessions happen. That's it. I'm sorry. The business cycle has not been wrung out of American economics. And, I like to use history as a guide. I like to do my own homework, but then check my homework with what actually has happened in history, because, I can be wrong. So let's use a template of what has happened in the past. And so going back to the last 4 or 5 recessions, after the last Fed tightening cycle, a recession has started, and the National Bureau of Economic Research defined recession as started 7 to 15 months after the last Fed rate hike. Now, whether it was July of the 2023 or upcoming November is going to be the last one, we don't know. But if you follow that range one way or another, I did it before, but I forget, so I'm going to be roughly correct. But it's something like March, maybe May of 2024. I think it was, May of 2024 or March of 2025. I did the math before, I just forget what it is right now. But essentially, history suggests that you'll end up seeing a recession later on. And now, usually you don't see a recession unless the Fed raises rates or there is a oil price shock. And I would argue that there has not been an oil price shock from the summertime. Mike, it sounds like you're going to remind me pretty well if you follow this closely, but oil is probably 60, 70. So a spike would be nearly, it depends how you define spike, but that would be then 120 to 140, and it's at 90, maybe it'll creep to 100. Now that's a rising oil price as opposed to a spike, but it's still rising pretty high. And I do think that the Fed isn't going to come to the rescue anytime soon. I think when
agree.
you look at core inflation, you look at inflation to come down a lot and right on script as you might have expected it to, quite frankly. But part of that script also is it went down a lot because of the base rate what it was compared to. We're going to have some tough times coming down from year ago comps. And so if the Fed is honest about trying to hit 2% on personal consumption expenditures, core CPE, it's going to have a lot more work to do. So we're going to have higher for longer in interest rates. We're going to have the lag effect hitting the economy, and maybe not an oil price spike, but higher oil prices. And the yield curve inversion is an interesting one. I don't know. I truly don't know if you can say that the yield curve inversion is causal, but it is at least correlative to recessions. And in my estimation, it doesn't necessarily cause a recession, but it does say the economy is fragile enough that if there's a shock, it can be tipped into a recession. Now, you can also say the U.S. economy is pretty darn strong. Like,
Yeah.
it hasn't lost jobs. It took the shake of Silicon Valley Bank collapse and other banks collapse. It is a resilient economy. So, maybe you go a few more years, but I tend to think you go another yearish before a recession starts.
Yeah. I wholeheartedly agree with what you just said. Thank you for your insight there.
Yeah, and then try to time the market when that happens too. That's a whole different, piece of algebra that you got to work with.
Well, Alan, your journey and your financial insights have been such a delight to listen to and hear about today. We really appreciate you sharing your wisdom with us and our listeners. And thank you so much for joining Mike and I today. We're looking forward to, seeing what's next with your community involvement and for Berkshire Money Management. So once again, we just want to thank you for joining us today on the What Matters podcast.
Thank you.
And to our listeners, thanks for tuning in, and come back next time for more engaging conversations on what really matters in wealth management and finance. Thanks, everyone.